Welcome to the Deep Dive. It is December 1st, 2025, and we are here to kick off the final month of what has been a truly consequential year.
It really has.
Our mission today is to try and cut through some of the noise and really analyze this intense contradiction that's defining the global financial markets right now.
Yeah.
We're starting December with a very clear risk-off mood, but that sentiment, it just clashes so sharply with the unbelievable resilience we've seen all year long.
It's a fascinating disconnect. I mean, if you just look at the immediate action this morning, that caution is front and center.
Right.
Major U.S. indices are selling off, and you see areas that are perceived as, highly leveraged or volatile, like crypto, they're getting hammered.
That's the snapshot today, but if
Yeah.
you zoom out, the story of 2025 is just pure defiance. The S&P 500 just closed out its seventh straight positive month.
Seventh. It's incredible.
It mounted the stunning comeback from a really deep 19% drop earlier in the year to finish November with a solid 16% gain year to date. I mean, we haven't seen that kind of sustained run in years.
And that momentum, it tells you that the structural forces driving the market are just much stronger than the day-to-day noise. JP Morgan actually distilled this down into three core themes.
Okay, what are they?
First, the broad-based market gains, which they're calling the everything rally. Second, just the underlying durability of the U.S. economy, which just refused to roll over into that recession everyone was predicting.
Right.
And third, the powerful, really accelerating innovation cycle, which is, of course, overwhelmingly dominated by artificial intelligence.
Okay, let's unpack this. I think we have to start with the foundational piece, which is monetary policy. To figure out if this durability can last, we've got to look at the central banks and this complicated policy puzzle they've created.
Especially here in the U.S.
Yeah.
The Federal Reserve is, they're already in an easing cycle. They cut rates back in September and again in October.
And the market is completely convinced there's more coming.
Oh, 100%. The short-term money markets are pricing in a near certain chance of another rate cut at the next FOMC meeting.
We're talking another 25 basis point reduction.
Exactly. And just for a quick refresher for you listening, a basis point is 1/100th of a percentage point. So, yeah, a 1/4% cut.
What makes this so tricky, though, is that this easing is happening while inflation is still running pretty hot.
That's the conflict. September's CPI, the Consumer Price Index, was still at 3%. That's, well above the Fed's 2% target.
So the justification for cutting rates isn't that they've hit their target, it's purely preventative.
Precisely. They're pointing to the cooling labor market to justify it. The unemployment rate ticked up to 4.4% in September. It's a really tough defensive choice they're making.
Do you wait for inflation to hit 2% and risk a deep recession, or do you ease now?
Exactly. Ease now, stabilize jobs, but maybe tolerate 3% inflation for a bit longer.
Now, here's where it gets really interesting, and frankly, a bit risky. Because of that major government shutdown we had, the Fed is essentially flying blind right now.
Yeah, they're missing crucial labor market and CPI data right up to their decision day.
So how do they even make a call?
Well, flying blind might be a little strong, but they're definitely handicapped. They have to rely on second-tier indicators like their regional summaries, the Beige Book.
But those are lagging indicators, aren't they?
They are, and that's the real policy risk. Can those summaries capture a genuine turning point in the economy fast enough to prevent a mistake? It's a huge question.
And this whole backdrop of, politicized uncertainty, it connects to a deeper structural concern. I think the European Central Bank, the ECB, recently raised a flag about this.
They did, about central bank independence.
Right?
And what's fascinating is the implication. The ECB pointed out that if markets start to perceive a central bank as being influenced by political factors...
So not fully independent?
Exactly. It actually leads to higher long-term interest rates.
Wait, higher? Why is that?
Because traders and investors worry that a less independent bank will be softer on inflation. So they demand a higher inflation premium on bonds to compensate for that risk. It's a crucial thing to keep in mind, especially as the U.S. discusses future Fed leadership.
Okay, so if we shift our focus across the Atlantic, the policy picture just diverges sharply. The ECB seems far more cautious than the Fed right now.
They are. They're holding their deposit rate steady at 2%. They did ease a few times earlier in 2025, but now they're pausing.
And why the pause?
Because inflation in the Eurozone is stabilizing much closer to their 2% goal, and growth is just modest. They're also very wary of geopolitical instability and all the trade risks that come with it.
But the really eye-opening divergence is in Japan. I mean, for decades, the Bank of Japan, the BOJ, was the poster child for extreme monetary stimulus. Now they've done a complete 180.
A complete 180 is right. BOJ Governor Ueda struck a really hawkish tone just today.
And by hawkish, we mean he's signaling he's ready to tighten policy, to raise rates.
Ready and willing. He pointed to two key things: fading global tariff risks, which have been slowing their growth, and surging domestic wages. He noted the minimum wage there is up more than 5%.
And the market reaction.
It was seismic, just immediate. Traders priced in a 73% chance of the BOJ hiking rates this month.
Wow.
And that caused yields on Japanese government bonds, their JGBs, to jump to 17-year highs. Think about that. A 17-year high in a country that spent 2 decades in a zero or negative rate environment. It signals a huge structural change.
So we have this intense policy divergence, all this uncertainty yet. The U.S. economy was just incredibly durable all year, defying almost every single prediction of a recession. How did it manage that?
It just had better shock absorbers than anyone expected. I think the key was corporate resilience. Companies kept their profit margins pretty robust.
So they could absorb higher costs, like those tariffs we'll get to, without having to do mass layoffs immediately.
Exactly. And crucially, the labor market cooled gradually. It avoided that sudden spike in job losses that usually signals the start of a really deep contraction.
You can see that gradual improvement in the forecast numbers, too. The consensus for 2025 U.S. GDP growth, it went from a pretty pessimistic 1.4% in May up to 1.9% by November.
And if you look at the Atlanta Fed's real-time tracker, the GDPNow model, that suggests even stronger growth. It's estimating Q3 growth at a really robust 3.9%.
That's not a soft landing.
No, that's a sustained flight. And it's largely powered by the consumer.
The consumer backbone just held up spectacularly. We're looking at holiday spending that's expected to top $1 trillion this season. That's an all-time record.
And that strength is exactly what fed the so-called everything rally of 2025.
And this everything rally, it wasn't just about U.S. large-cap tech, was it?
Not at all. And that's what's so fascinating, the sheer diversity of where the growth came from. Gold, for instance, was a remarkable leader. It posted a staggering 58% year-to-date return through late October.
58%. Why gold? Is that just pure fear driving that?
It's a combination. Geopolitical uncertainty, yes, definitely a factor. But also easier financial conditions globally. When the Fed signals it's going to ease, that tends to weaken the dollar and support hard assets.
And it wasn't just gold.
No. The rally was global. U.S. equities, especially emerging markets, were up around 28%. They were actually outpacing the U.S. for a good chunk of the year. It made geographical diversification really effective for the first time in a while.
That said, the Nasdaq did hit some turbulence in November, its first monthly loss since April, driven by some concern over AI valuations. Is this a healthy pause or a warning sign?
That really raises the big question for you, the listener. Are we just rerunning the late 90s dot-com bubble?
Right.
Most analysts suggest the current environment is fundamentally healthier. I mean, during the peak of the dot-com era, the Nasdaq price-to-earnings ratio soared to 91 times earnings.
And where is it now?
Right now, it's sitting at a much more reasonable 32 times earnings. It suggests that fundamentals, actual profit and growth expectations, are driving the AI sector, not just pure speculation.
And we also saw market leadership broaden out a bit in the fourth quarter, moving away from just those big growth stocks.
We did, yeah. A clear rotation toward value. The Russell 1000 Value Index actually outperformed its growth counterpart, with sectors like healthcare, energy, and consumer discretionary leading the way. That's usually the sign of a healthy, non-concentrated rally.
Yet all of this economic durability is constantly being tested by this fragmenting, highly politicized global environment. And nowhere is that pressure clearer than in geopolitics and trade.
Policy itself has become a major market shock. Just look at the tariff data. The U.S. average tariff rate, it surged to a peak of 29% in mid-April before it settled back down to around 15% by June.
And that creates what you call an asymmetric dual shock, right?
Yes, let's break that down. For the U.S., the economy imposing the tariffs, they act as a classic supply shock. Imports get more expensive, that raises input costs for companies, and it feeds domestic inflation.
But for the countries being tariffed?
For them, for major trading partners in, say, Asia or Europe, they face a negative demand shock. They can't sell as much to the U.S., which weighs on their prices and actually amplifies disinflationary trends over there.
So one policy creates inflation at home and disinflation abroad, all at the same time.
Exactly. It's a global wedge.
And that fragmented environment, it also keeps energy markets on edge. I mean, Middle East instability feels like a permanent fixture in the price of oil now.
Absolutely. These geopolitical earthquakes are consistently adding what analysts figure is a $2 to $4 per barrel risk premium to the price of oil. That's just a baseline cost of global tension.
And the worst case
The
scenario.
worst case low probability scenario, like a severe disruption to the Strait of Hormuz that could send oil prices surging dramatically, potentially to $110, even $130 per barrel.
And that explains why investors are pouring into hard assets. The whole commodity complex is basically pricing in this mix of uncertainty and potential supply breakdown.
It's a very specific kind of bet. Take silver. It surged to a fresh record high today. It's up over 94% year to date.
94%.
The velocity of that gain tells you the market is betting on high inflation coupled with a breakdown of global supply chains. And industrial metals are following. Copper hit a new record high on supply crunch fears. It's up nearly 30% this year.
That paints a picture of massive global political risk. But let's pivot to the less visible risks, the structural ones, specifically the warnings coming out of the ECB about non-bank financials.
This is critical. It's a potential source of fragility that's outside the traditional banking system we usually watch so closely. The non-bank sector includes hedge funds, private equity, and the huge booming private credit market.
And why are these institutions seen as more dangerous than, say, a traditional commercial bank?
It's primarily three things: high leverage, opacity, and illiquidity. Traditional banks have strict capital rules, close supervision. Non-banks don't.
So they can take on more risk.
Way more risk. They use high leverage, their investment strategies are often complex and opaque, and their portfolios hold assets you can't sell quickly if you need cash. Illiquid assets.
So the real danger is transmission, if one of these big funds gets into trouble.
Exactly. The ECB is worried about the interconnectedness. Traditional European banks have significant exposures to these non-bank players. If a major fund runs into trouble, it can transmit that risk straight into the more stable, regulated banking system. That is the core threat they're flagging.
And sticking with Europe, the ECB also highlighted a specific vulnerability in housing, using Spain as an example. They estimate the Spanish market is overvalued by about 17%.
But what's fascinating is why it's overvalued. It's not the same kind of credit bubble we saw 15 years ago with irresponsible lending.
So what is it?
It's purely a supply bottleneck. It's driven by demographics. Spain's population is growing by 500,000 people net per year, and the rental supply simply cannot keep up with that demand.
That makes perfect sense. Demand is just overwhelming supply.
And the ECB made a really strong point here. They noted that regulatory efforts to control rental prices, things like rent caps, they actually reduce the incentive for developers to build new rental units.
So it makes the core problem worse.
It achieves the exact opposite of its goal. It worsens the shortage, especially for the most vulnerable people.
This is such a complex mosaic. We have these powerful forces of resilience and an AI-fueled rally fighting against policy uncertainty, extreme central bank divergence, and these deep structural risks. It's a constant tension.
It is. And as we start December, it's only natural for investors to look to history for some kind of guidance, specifically to the famous Santa Claus rally.
The idea that December is just inherently bullish for stocks.
And it's based on very good data. Historically, since 1980, December has been the strongest month for stocks. It's delivered positive returns 71% of the time, with an average gain of 1.2%. History suggests there's often a tailwind as the year closes out.
So what does this all mean for the month ahead for you, our listener? We start December risk-off, but history says we should rally.
The provocative thought for you to consider is this. Given that the market started December on such a clear risk-off note, and we're facing these profound structural fissures, from tariffs creating asymmetric inflation to the threat of contagion from the shadow banking sector, is historical seasonality enough? Is it enough to overcome today's highly politicized and fragmented global economic landscape?
And what signal will that unprecedented December data blackout and the looming contentious Fed decision ultimately send to history?
That is the question defining the final act of 2025.